All right, welcome back. The market is up a little bit, but not very enthusiastically, I should say. 36 points, 17,428 is where we're at. Vikash Kumar Jain is strategist at CLSA, and he's joining in for some market talk. Vikash, great to have you with us here. Thank you very much for your time. So are we at a bit of an inflection point? You run that kind of sentiment index. What is that telling you? If you've kind of if you've looked at it recently, one way to look at it is, will the markets come back to the lows of the budget day, and perhaps we've taken some froth off and things should get better from here? The other way is, there are no real big triggers, right, for the market to do well or for people to come in aggressively. So maybe it continues to see this drift lower. I wanted your thoughts on this.
Hi, thanks for having me. So I think when you tell an inflection point, there has to be some powerful move on the other side. I would say, just since you specifically ask on the sentiment index, that's our proprietary India Bull Bear Index. That index has recently gone back into bearish zone from neutral, but this is around 17-18% bullish kind of a zone, or 82% bearish. It's not really extreme. What I typically look at as calling extreme is when we hit less than 10% bullish. We are not there yet. So from that perspective, yes, the market is lighter for sure, but it's not really in what can be traditionally called at an extreme bearish point, which leads to a contra move. So yes, it's a lighter market, but it's not really at that point of time where I can thumb the table and say that everyone is too bearish and maybe we could have a contra move. Not yet.
Okay, Vikas, hi, good morning. Thanks for that. Just let's talk about individual sectors, right? Banks have been the biggest underperformers for the last many months. But I was going through your note where you say that the risk reward for the overall sector has improved quite a bit, with valuations being undemanding. So is it a good time to be buying banks? If yes, which are the ones that you like between private and public?
I think you're referring to the analyst note. I think, yes. So I mean, that's the opinion of our banks team, that yes, there is that could be a point where, on a valuation basis, some of the banks are looking good. However, what we need to understand is India is simply catching up to, or there is some kind of a reversion to the outperformance we've seen over the last 2, 3, 4 years. And, this is versus China or versus the EM markets in general. And since flows could reverse in a situation where India is no more the darling market, that's changed rather dramatically. I mean, when we had our conference, and I think that could have also been the time when we last spoke in November, that is the time when everybody still wanted to be positive on India and, see how much the last 3, 4 months have done to us. So from that perspective, I would say that any big move for this large sector would clearly depend on flows. Since it's a reasonably well-owned sector, till very recently, overweight banks was a pretty consensus call, although, that's something which we also need to bear in mind. One needs to look into that from a perspective of what happens to the overall markets. It's going to be tough for that sector to do well without the overall market improving. So, it's such a large weight.
Hi, Vikas. Good morning. Vikas, what about earnings? Suddenly we're getting a little bit cautious on earnings. Earlier, maybe 4 or 5 months ago, everyone was considering mid-teens is a given for the next couple of years on EPS growth. How much have you scaled back earnings? And now what are you working with for FY24 and FY25? Do we get to that 1,000 odd mark?
So, good question. And this is where it's interesting. In fact, this particular quarter, consensus downgrades were not so large. It was only about 1 to 1.5% downgrade by consensus in Nifty earnings for FY23 to 25. In fact, we did not really move our estimates much. On the slight, could have been a slight upgrade for CLS estimates, because we started the year and the quarter where we were 7 to 8% below consensus. Now at the end of the quarter, we are like 5 to 6% below consensus. So, we're still 5 to 6% below consensus. So from that perspective, we still expect some downgrades, but so far, it's not been that bad, at least the reporting season. Other than the oil marketing companies, expectations were better than at least our estimates.
Vikas, I put out a piece looking at earnings again, this earnings downgrades, upgrades picture. And what I found was that, and this is the best estimates on Bloomberg, for Nifty 200 set of companies, right? About 57% of companies saw downgrades to their FY24 estimates. So maybe, so that is, so 113 out of 200 companies saw downgrades. And if you look at the where the downgrades were, the biggest downgrades were, I mean, the entire consumer space, right? I mean, the consumer durable space, Crompton, Whirlpool, Dixon, the retail names, ABFRL, Page Industries, InfoEdge, Jubilant Foodworks, pharma names. I mean, pretty steep cuts.
That's right. But if you think about it, those are actually stocks which do not have that large a contribution to overall Nifty earnings. Like, for example, banks were still okay. They had a pretty good quarter. Banks and commodities actually have a far bigger share in earnings of Nifty as compared to, say, for example, some of these commodity names. They do not have that much of a share.
So you're talking about Nifty earning. Okay, got it. Sorry. No. My only point was broader market. Sorry, go on. Yeah.
I was talking about Nifty earnings. Since that's what we popularly track. We started with being 7 to 8% below consensus. Now we are 5 to 6% below consensus.
Okay. The other trend that I wanted to talk to you about was the risk to the monsoons from the El Nino, and that's causing perhaps a lot more accelerated pressure in the rural markets. That's something that people are forecasting. So it could impact tractor demand, it could impact the small car segment, rural consumption as well. And this is a space that's already ailing. What do you do here? Do you stay away from these names or do you look to buy the dip?
Yeah, so I think we've actually stayed away from consumption for a long time. In fact, from October, we run this focus portfolio where we only look at large and liquid names. 10 to 15 large and liquid names is what typically our portfolio makes up for. We've not had any weight in consumption since October. Only recently, we added one stock, which is not really dealing with rural so much. It's more of a premium and urban consumption stock, which we added. So beyond that, we have no exposure to consumption. In fact, even in the recent quarter that passed by, we tried to look at the overall quarter as a more bird's-eye view, where we kind of got into creating some groups and comparing them. One of the groups that we created was rural and first was consumption versus investments. And in general, performance of capex and investment-linked stocks in the quarter gone by was much better than consumption-linked stocks. And within consumption, we further broke it down as the next leg as urban and rural consumption. And clearly, the urban consumption stocks were still doing well. So, there was some hope that if the monsoon is normal, and that should give a kind of a boost to rural consumption. If there are risks to that as well, then of course there's going to be a hit to that, as that expectation as well. What we need to appreciate is that the government in its policy making is clearly focused on the investment in the supply side, despite this being the last budget ahead of the last full budget ahead of the elections, or the primary elections 24. The government has not done anything specifically for consumption in general. So I would say that, consumption will only slowly pick up unless there is some kind of a push that comes in. The route through investment flowing into demand is a slower process. So that's why we need to be a bit more patient. But the problem is many of these consumption names are still trading at very expensive valuations, like 1 to 2% earnings yield in a world which has gone from US bond yield being 1% to 4%. So I would say that that's something which kind of limits their ability to do well in a market where rates are likely to stay high and their demand, push is not going to be very evident.
All right. Well, we leave it at that. Vikash, thanks a lot for joining in and have a great 2023 until we speak again. That's the word coming in from CLSA on the overall macro picture. But let's drill it down to how the charts are looking now. This is our special segment, Charting Trends. Rahul Sharma, the head technicals and derivative research at JM Financial, is joining in to discuss about key market levels as well as how stocks are expected to shape up. Rahul, thanks for joining in. This has been quite a disappointing year for the bulls so far. I mean, the Nifty is down about 4%. The mid-caps are down about 5% year to date. Do you see more pressure on the charts? And, you know, this budget day low that was breached yesterday, do you think the markets could stay below that through the course of the next many months?
Yeah, hi, very good morning. So definitely markets have been into a downward spiral and, even breaking the budget days lows. But, we have to see this market in three different magnifying glasses. One is the very micro short term, the short term and the medium term. So if we talk of the very micro near term, there is a good possibility because we are in an oversold territory, a bit of bounce back can be expected until 17,600, 17,650 odd. But post that, I think it's basically we may see the bounce back fizzling out and the Nifty heading for further downside. Now, technically, the structure is quite bearish ever since we broke the 17,800 mark. And this was a multi-week consolidation that we broke down from. So my sense is somewhere around 17,000, a bit of support the market can expect, a bit of buying opportunity one can look at. And the final capitulation may happen at 16,600. We believe over the next 2 to 3 weeks, the entire down move should play out. The entire down move should mature. And this is, as of now, a market where any rises can be looked upon as a shorting opportunity, especially in the short to medium term. Speaking of relative comparison to the US markets, so last year we enjoyed the outperformance vis-a-vis US markets. Now the entire froth is completely out. So if you see the Nifty 500 versus the S&P 500 relative comparison, we've come back to the long-term support line of the entire outperformance of the US. So my sense is if you take like a 2 to 3 month kind of a view, we have to be a buyer in this dip, maybe around 17,000, maybe another tranche can come in at 16,600, 16,700. And my sense is we should see a reversal happening in the next 2 to 3 months. So very micro short term, a bullish bounce back can be expected from here. In the short term, we remain a sell on rise kind of a market where we are expecting 17,000 floor to be tested. And if you have a slightly medium term outlook, which is 3 to 4 months, I think this dip can be a good buying opportunity going into the next few months.
Okay, got that. Rahul, good morning. Prashant here. So what are the best setups according to you? Let's get down straight to actionables in your opinion. Which are the best setups in terms of risk rewards from here? Go on.
Yes, Prashant. So, there are a couple of sectors which we like a lot. I think the best, in terms of the technical setup, the risk reward, the headroom, is the public sector enterprises index, PSE index. Now, in that, NTPC is something that we like a lot. The stock has been relatively holding off well in spite of what has happened in the broader market. We believe that there is a good 25 to 30% upside to be had in NTPC in the coming months ahead. In fact, around 170, 175, one can look to buy. There is a very strong base that the stock has formed around 160, and one can expect a target of 200 in the next few months and possibly 225 by the end of this year as well. So from a macro perspective, PSE space looks very good. From a trading perspective, I think cement as a sector has held on very well. So we have our eyes on the sectors which haven't fallen much. So if you take something like an Ultratech cement, the stock is pretty robust in terms of the technical setup, trading above all its short-term and long-term moving averages. Around 7,000, 7,200, you can accumulate long positions with a stop loss maybe at 6,800. And we believe there's a good chance that the stock heads towards the 7,800 to 8,000 mark on the upside. The third stock, which we like very much on the macro technical outlook, is Bosch Limited. The stock has come out from its multi-month, I would say, resistance levels at 18,000. The stock is ripe for another round of an up move, which where we can expect levels of 21,000 on the upside in the next 12 months or so. So if you're an investor, I think this is one space which looks pretty solid, can buy with a stop loss placed at 17,000. And we believe, banks have been a problem area for the markets for sure. But now what has happened is banks have become a consensus trade. Like for example, on Friday session, we saw the combined open interest shooting up by 37%. And every time we've seen a consensus trade happening, we've seen the market reverses, the market at least takes out the traders during those periods. And we believe that, one round of short covering move can be expected in the market, which is when again it will become a shorting opportunity again. So all the stocks that we've discussed, I think it's best to do it in tranches. Maybe a couple of tranches over the next 2 weeks would help in terms of the entry price points for these investments.
Okay, so you spoke about Ultratech Cement that you like. You also like Bosch. Anything else that you want to leave us with in terms of trends, either stocks or sectors?
Yeah, so speaking of the rest of the market, so we have leadership is something that is clearly lacking in the entire scheme of things. But in terms of the conglomerate, so there is a comparison between ITC and market. So for example, when in the late half of January, we saw ITC taking off, market sort of taking into a nosedive mode. This time around, something's the other way around is happening. ITC is losing steam, and market is slowly, gradually building up momentum for a reversal. So I think this pair trade where you go short on at this point in time, it looks like a short on ITC and a long on Nifty, especially for traders. I think there is a good chance that this pair trade works out to be well. So ITC is one stock that we advise to book profits as of now. Maybe in a dip or something, investors can look to re-enter. The stock has done its bit technically. If you have a long positions in this, it is advisable to book. And we believe there is a good chance there is a pullback that happens in the same.
Rahul, actually, I put out ITC in the morning on Market Laser as something which perhaps was, which bears watching. Maybe if we have the chart, we can kind of put that up once again. It is bumping into an important resistance zone. And you're saying that the reverse may work. The market does well and ITC perhaps goes the other way. That is the graphic that I put out in the morning. Yeah, there you go. That's ITC. We'll see. But I think Rahul also concurs with that view. Anything else, Rahul, in terms of specific names, outliers you may want to mention, which comes up on your radar?
Yeah, so in fact, telecom is one space where we feel there can be a bearish outlook. Like for example, Bharti Airtel is one stock which has been continuously grinding on the downside. Yesterday we saw in the last two sessions, it has been sustaining below the 760 breakdown point. I think there is a good chance we could shave off another 5, 6, 7% from these levels. Metals is one area which is strongly in the grip of bears. So this sector continues to be a sell on rise kind of a sector. Banks have done their bit on the downside, so I think it's very heavily oversold, so might as well avoid shorting that. In fact, PSU banks, some of them showed some very good green shoots in yesterday's session, and we could very well see that translating into a bounce back in the Bank Nifty. So I think as far as sectors are concerned, telecom remains a negative. It is metals which remain a negative. Sectors which look good, PSE. Sectors which look good, cement. So I think this is a mix. This is a market where you have to have a mixed strategy, a long and a short approach, because clearly we've not seen major trends developing on either side. And I believe it's best to trade as per levels. And take one day at a time with the kind of sector rotation we are witnessing on such a fast and massive scale.
Okay, thanks a lot for that. Very helpful with all the charts that you're seeing for us. Thanks, Rahul, for joining in. Let's slip into a quick break. On the other side of the break, Manisha Gupta is here to put focus on the commodity market. Stay with us. Welcome back. Well, the equity markets are largely flat, but one of the stocks in focus is Vedanta. Keep an eye out on that. The stock is now down almost about 4% and volumes are also picking up there. We'll try and get you more details on that, but that definitely is the chart of the moment. Almost 6% gone on Vedanta now. Let's shift focus to the commodity markets. Manisha is joining in. Manisha, what's the one commodity that you're looking at this morning?
Well, I'm looking at metals, and even as the month of January was a great one because we saw double-digit percentage gains there. The Fed clearly has given up a lot of those gains there. The strength in US dollar clearly is one of the reasons that is weighing on. We are looking at dollar index now trading at a 7-week highs at around 105, and that's weighing on many of these dollar-denominated commodities. The markets also are looking at the Chinese recovery, which has at best has been uneven. The numbers or the expectations in the month of Jan clearly seem to be going away now. There also is a build-up in inventories for many of these metals. That's weighing on. And the markets are dealing with expectations of a prolonged US restrictive policy. We also are looking at very strong US economic data, and that tells you that the higher Fed rates perhaps could become a possibility. And then it is also about liquidity declining as the US Fed continues to unwind its books. So take a look at the market prices then, and we have seen the copper prices trade at around 2-month lows. Aluminum prices have come off the 7-month highs that it hit on 25th of January. If you look at the Chinese production, that has hit a record high in the year 2022, up by nearly 4.5%. Iron ore prices also have eased from its 8-month highs. Here as well, we are looking at pollution concerns in China and the stock really building up right now. So off 8-month highs on this one, and the iron ore prices have now declined below $130 a ton. There is weak demand coming in from the steel mills, and that seems to be weighing onto those prices. Steel prices itself have come off its 8-month highs. Nickel is trading at around 3-month lows now, below $25,000 a ton. In nickel as well, the Indonesian production in the previous year gained up by nearly 50% to 1.58 million tons. So there is production now picking up, inventories building up, and the Chinese demand not even, all of that weighing onto the markets. And that chart clearly clears it for you, basically. So but the month of January saw nearly 10 to 15% of gains coming in across of these metal prices. In the month of Feb, you've seen prices decline anywhere between 6 to 12%. Steel is the only one which continues to trade in the positive for 2023, even now with that profit taking. But as you can see, zinc, aluminum and iron ore essentially have declined between 10 to 12%. Copper prices up 6% for this year now. But apart from that, Feb clearly hasn't been such a great month. And the markets do believe that the first half of March, the 15 days, also could see some more profit taking here.
Okay, thanks a lot, Manisha, for that. Let's get back to buzzing stocks now. Indiabulls Real Estate is the one that's moving around. Nimesh is here to tell us why. Nimesh, over to you.
Hi, Sana. The stock is down 5% surprisingly, but yesterday evening there was an announcement there's going to be a change in the management, top-level management. So the current MD, Mehul Johnson, has resigned as the MD of the company, and he'll be replaced by Sachin Shah as a ED for the next 5 years. Additionally, the company has also announced appointment of 3 new independent directors for a period of 3 years. Effectively, what this means is there is going to be a further control in the hands of Embassy. Remember, there is a proposed merger between the Indiabulls Real Estate Group and the Embassy Group, which has been pending in NCLT for a very long time. The next hearing for the NCLT is scheduled for tomorrow, which is March 1st. So that will be an important trigger to track as far as the merger is concerned. But in an overnight changes, couple of big changes has happened in the management, and what this alludes to is further more control in the hands of Embassy Group.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's hop across to Vivek. He's here to tell us about the MSCI rejig. Vivek?
Well, absolutely right. You know, all of these announcements were made earlier in February, but the changes will come into effect today. In fact, all of the passive funds that actually track the MSCI index will be tracking these changes and making these changes in their portfolio today. So let's have a look at which are the stocks that will be impacted. 2 important stocks, Bank of Baroda as well as CG Power. These stocks will get added to the MSCI Standard Index. Expect flows of $135 million into Bank of Baroda. CG Power expect flows of a little over $150 million. On the other hand, Biocon is expected to see outflow of close to $78 million as it is being removed from the indices. Well, the other important group to keep a track on is the Adani Group. Now, remember, there was quite a bit of flip-flop in from the MSCI in terms of the treatment of the Adani Group within the MSCI indices. So today, the net impact will be there will be an outflow due to a weight reduction in Adani Enterprises, Adani Total Gas and Adani Transmission. MSCI has postponed the weight reduction on the back of the fact that the stocks were continuously hitting lower circuits. Apart from that, there are 24 additions and 5 deletions in the MSCI India Small Cap Index. So today, all of these names will be active, especially in the last hour of the trading session.
Okay, all right. Thanks a lot for that, Vivek. Well, Vesuvius India, that's the other stock that's in focus. It's under some pressure. On a year-on-year basis, the numbers look good. The problem is that on a sequential basis, there was a bit of a decline on the revenues. The margins as well came down to around 11%. That compares with around 14% on a sequential basis. So that 300 basis points, decline out there. And also the stocks trades at around 30 times its trailing earnings. So maybe no valuation comfort as well out there. So the stock is down 10%. But keep in mind, in the last 1 month or so, we've seen a big run-up, on that stock. Focusing on the other one, that's Vedanta. That's the larger name in there, and that's under some pressure. Let's run you through the key fears and why the stock is under pressure. One is the bond yields have surged to more than 35% on Vedanta Resources. I think last count it was close to around 38%. So the street is fearing that the promoter entity, that's Vedanta Resources, could default. That's point number one, and it's reflected in the bond yield surging up. The second factor is the shareholding as of December 2022. On both the listed entities, that's Vedanta as well as Hindustan Zinc. The promoter holding is high, but bulk of that has been pledged. For Vedanta, close to 99% of the holding is pledged. And for Hindustan Zinc, out of the total promoter holding, 88% is pledged. So that's a bit of a worry. And the third point is Hindustan Zinc's buyout of, Vedanta's international zinc assets at close to around $3 billion. That was expected to bail out the company because in turn, the promoter entity would declare, a dividend. They would get that money as well. So that's hit a roadblock, which is a bit of a worry. Keep in mind, the government of India has close to around 30% stake in Hindustan Zinc, and that's the reason why it hit a roadblock. So put all these factors together, it explains why the stock is under pressure. Some clarification from the promoter entity is awaited. So let's see whether or not they can wriggle their way out of this one. Well, for the time being, though, we'll slip into a short break. But on the other side, our special segment, it's the economy. Lata will be chatting with Rob Subramaniam of Nomura, as well